Welcome to the Byte-Size Brief. Today we are putting DTE Energy, that's DTE, completely under the microscope. Let's get into it. So imagine opening your fridge to find hundreds of dollars of groceries, just totally spoiled from like your third power outage this month.
Yeah, which is incredibly frustrating.
Right. And then the very next day, you open the mail to see your electric company just raised your rates to help fund nearly $1 billion in shareholder dividends. I mean, that is the exact visceral reality fracturing Michigan right now. And it sits at the absolute center of a massive, glaring paradox in the utility sector.
It really does, because, over on Wall Street, DTE Energy, or DTE, is positioned as this incredibly steady, reliable dividend payer. And lately, they're landing these futuristic, massive AI data center contracts.
But on Main Street, it's a totally different universe. You have this boiling public backlash over grid reliability, ancient infrastructure, and relentlessly rising monthly bills.
Yeah.
So today, our mission is to separate the emotional noise from the hard financial numbers. We are objectively analyzing DTE Energy, DTE, taking a look at their recent financial performance, the sheer scale of their infrastructure spending, and the real-world risks threatening their growth trajectory, just to see what this all means for regular investors.
Sounds like a solid plan.
Okay, so let's start with the basics. Compared to last quarter, what actually moved the needle here?
Well, to understand the current trajectory, we really have to look at a rather sharp divergence in their core segments. Their electric segment revenue actually jumped by $100 million year over year.
Wow.
Yeah, hitting $541 million. But conversely, the gas segment dropped by $25 million over that exact same period.
Wait, hold on. $100 million up in electricity, but gas goes down.
Hmm?
What's driving that split? Because usually those two move somewhat in tandem, based on the regional economy.
Normally, yes. But it highlights a fundamental mechanical shift in how legacy utilities operate today compared to, say, even a decade ago.
How so?
Well, historically, a combined gas and electric utility balanced out, right? Gas provided steady winter heating revenue, while electric handled the summer cooling spikes. The drop in gas revenue recently is partially tied to a relatively mild winter.
Oh, right. So inherently depressing natural gas heating demand. People simply run their furnaces less.
Exactly. But a $100 million jump in electric implies something much more structural is happening. The electric grid is absorbing massive, constant new layers of demand.
Are we talking about EVs or?
EVs are a part of it, yes. The steady, compounding adoption of electric vehicles is huge. But we are also looking at the broad electrification of industrial processes and advanced manufacturing facilities returning to the region.
Oh, I see.
Yeah, so electric loads are no longer just seasonal peaks driven by July air conditioning. They are becoming heavy, continuous, year-round baseloads. The whole business model is rapidly pivoting from seasonal balance to heavy electric dominance.
And looking at the numbers, I mean, they really seem to be capitalizing on that dominance. Their 2025 operating earnings hit $7.36 per share.
Right.
Furthermore, they just raised their 2026 earnings per share guidance to a range of $7.59 to $7.73. I mean, that translates to a very confident 6 to 8% growth rate. But hold on. How does that actually affect DTE Energy, DTE, and its stock price for regular investors like me?
Well, the market is already pricing in that growth. The stock is currently hovering right around the $146 to $148 mark.
Okay.
And based on the projected earnings growth, analysts currently view it as slightly undervalued, with an average consensus price target sitting up at $152.17.
Plus, as an investor, you get an attractive 3.1% dividend yield just for holding the stock. From the outside looking in, getting paid a solid dividend while waiting for the stock to hit its price target looks like a very safe, comfortable place to park your money. But a 6 to 8% growth rate for a massive legacy utility company doesn't just happen organically, right? They have to physically build the capacity to generate and distribute more power.
They do. And the underlying mechanics of that growth require just a mountain of capital. DTE Energy, DTE, executed a record $4.3 billion in capital investments in 2025 alone.
$4.3 billion just in 1 year.
Yeah. And looking ahead, the company is committed to a colossal $36.5 billion capital expenditure plan through the year 2030.
Let's just pause on that number at $36.5 billion over the next few years.
Yeah.
I mean, an older utility company doesn't just suddenly decide to spend the equivalent of a small country's gross domestic product on a whim. What is forcing their hand right now to deploy that kind of extreme capital?
And data centers.
Oh, of course.
We are witnessing a power grab like nothing we have seen in modern utility history. Training massive language models requires colossal server farms. Those servers process billions of calculations per second, which generates immense heat.
Right, which then requires constant industrial-scale cooling systems.
Precisely.
And unlike, say, a traditional car factory that might operate in shifts and lower its power usage at night, an AI data center runs at absolute maximum capacity, 24 hours a day, 7 days a week. It's a relentless, unyielding draw on the grid.
And DTE Energy, TTE, is actively positioning itself to supply that relentless draw. They recently secured a landmark 1.4 gigawatt load agreement for Oracle's new data center in Saline Township.
Wow.
Yeah, alongside additional deals with Google. In total, the company is looking at 2.1 gigawatts of non-binding agreements currently in the pipeline.
Let's contextualize a gigawatt for you listeners out there because it sounds like a sci-fi term.
Sure.
1 gigawatt is roughly enough to power about 750,000 residential homes.
Right.
So DTE Energy, DTE, is essentially agreeing to add the equivalent power draw of a massive metropolitan city just to support a few tech campuses. But wait, why are they choosing Michigan for these facilities instead of traditional tech hubs?
That's actually really interesting. Michigan offers a highly attractive environmental profile for data centers. The cooler ambient climate naturally reduces the immense cooling load required for the servers for a significant portion of the year.
That makes sense.
Additionally, the proximity to the Great Lakes provides abundant access to fresh water, and that is critical for the massive evaporative cooling systems these facilities employ. So the geography itself is drawing the tech giants in.
Now, the economic theory the company presents, and it's kind of like DTE Energy. DTE just landed the biggest anchor tenants in them all, is that because these tech giants use so much power, the fixed costs of running and maintaining the broader grid get spread out over a much larger pool of energy usage.
That is the narrative, yes.
Right, so the tech giants essentially subsidize the grid maintenance, which theoretically lowers the utility rates for everyone else in the state.
Exactly. The theory relies entirely on economies of scale. If the total volume of electricity sold increases dramatically, the cost to deliver each individual unit of electricity should theoretically decrease.
Theoretically.
Key word there, because achieving that scale requires an enormous upfront investment in high-voltage transmission lines, brand new substations, and heavy grid reinforcement just to connect these data centers in the first place.
Right.
And this is where the Michigan Attorney General is aggressively stepping in.
Because the state is looking at the long game here.
Yeah.
If Oracle or Google decides that artificial intelligence isn't as profitable as they thought in a decade, what happens to the multi-billion-dollar substation built specifically for them?
It becomes a stranded asset. The Attorney General wants ironclad legal guarantees that everyday ratepayers won't end up subsidizing the multi-million-dollar infrastructure upgrades required by big tech.
Yeah, because if a tech giant pulls out of an agreement after the infrastructure is already built, the capital is already spent.
Exactly. And under traditional utility models, those costs would inherently flow back into the general rate base, meaning everyday citizens would see their bills skyrocket just to pay off the debt on an empty, useless facility.
That is a massive, tangible financial risk for DTE Energy, DTE. And on top of the state-level regulatory scrutiny, you have local communities fighting back on the ground. Right?
Oh, absolutely. Rural and suburban townships are implementing moratoriums because they just don't want the constant droning hum of industrial cooling towers, the massive local water usage, and the sheer physical footprint of these data centers disrupting their towns.
Which is totally understandable. But those local battles can stall construction builds for months or even years.
The timeline risk is significant here. The company's earnings guidance is modeled on these data centers coming online at specific dates. So local moratoriums directly threaten the revenue realization of that $36.5 billion capital expenditure plan.
And whenever we talk about the state worrying about who pays for the grid, we have to look at what residents are already paying today. The Michigan Public Service Commission, or the MPSC, recently approved a massive $242.4 million rate hike for DTE Energy, DTE.
Concurrently, the company is generating roughly $1.5 billion in annual profits, while paying out approximately $950 million in dividends to their shareholders.
Yeah, and those distinct financial realities existing at the exact same time are causing absolute chaos in the community.
I can imagine.
Oh, it's wild. If you dive into the public forums, specifically Reddit's Durham, Michigan, and Ann Arbor, Detroit communities, the frustration is just boiling over. During the recent concurrent power outages and rate hike announcements, things got so hostile that the moderators had to activate mitten mode.
Mitten mode.
Yeah, that is essentially a total lockdown of the forums to stop the overwhelming flood of vitriol. People are furious. They're losing power for days, throwing out hundreds of dollars of spoiled groceries, and then opening their mail to find out their rates just went up again to fund nearly $1 billion in shareholder dividends.
And the numbers back up that anger. The 2025 J.D. Power Electric Utility Residential Customer Satisfaction Study actually quantifies that exact sentiment.
What was the score?
DTE Energy, DTE, scored 485 out of 1,000. That metric placed them second to last among large utility providers in the entire Midwest region.
Wow, second to last. But here's where I want to push back heavily on the corporate narrative. They claim these rate hikes are strictly necessary for grid improvements. But from a retail investor standpoint, when your core product, delivering basic electricity fails repeatedly and your customer base absolutely despises you, doesn't that massive PR nightmare eventually threaten the bottom line?
You would think so.
Right. Because a business simply cannot sustain that level of consumer hostility forever without a total collapse in revenue.
Well, in a standard free market environment, the company would face mass customer attrition and likely bankruptcy. But DTE Energy, DTE operates as a regulated monopoly.
Oh, right.
In exchange for providing universal service, the state grants them an exclusive service territory and essentially guarantees them a specific rate of return on their capital investments. The captive customer base prevents an immediate revenue collapse.
That makes sense.
However, to be objective here, the company is deploying capital to address the mechanical failures. They are not simply absorbing the rate hikes as pure profit, they really are executing a physical overhaul of the distribution system.
Okay, but are we talking about just sending out more trucks to trim tree branches, or are they making actual structural, technological changes to the grid?
Well, vegetation management, aggressive tree trimming is a major component. But the structural technological changes are what matter for long-term reliability. DTE Energy, DTE, reported a 90% reduction in average outage duration compared to 2023.
Wait, really? 90%?
Yes. And this metric is primarily driven by the deployment of new smart grid devices, specifically these things called automated reclosers.
Okay, automated reclosers. How does an automated recloser actually keep the lights on during a storm? Let's break down the mechanics for the listeners.
Sure. Historically, utility distribution grids were built on a radial design. Power flowed in one direction from the substation down the line to the neighborhood. If a heavy tree branch fell and severed the line, everyone downstream of that physical break lost power.
Right, the classic domino effect.
Exactly. And a technician had to physically drive miles of line, visually locate the damage, and manually reset the system after repairs.
Which is exactly why people would sit in the dark for 12 hours waiting for a truck.
Precisely. An automated recloser changes that dynamic entirely. It acts as a localized, highly intelligent circuit breaker connected to a central communication network.
Oh, interesting.
Yeah, so when a fault occurs, the recloser senses the disruption, automatically isolates the exact block where the physical damage occurred, and instantly reroutes power through secondary pathways to the rest of the grid.
So you contain the bleed.
Right.
Instead of an entire township going dark for half a day while a truck drives around searching, maybe just one specific street loses power and the repair crew receives the exact GPS coordinates of the fault.
That localized isolation is the mechanical reality behind the 90% reduction in outage duration. The company is actively spending the capital to modernize a historically fragile infrastructure.
But, and this is the big but, to modernize that infrastructure, deploy these smart reclosers, and build out the massive data center capacity, they need that $36.5 billion.
That do.
And the $250 million rate hikes alone aren't going to cover that immense gap. So how are they actually funding the rest of this expansion?
This is the critical part for investors. DTE Energy, DTE, anticipates issuing $500 million to $600 million in new equity annually through the year 2028.
Hold on. So they're printing more stock to pay for the upgrades. If they're issuing $600 million in new equity annually, they aren't just raising customer rates, they're diluting the stock.
Yes, equity dilution is a major factor here.
So for anyone holding DTE Energy, DTE, right now it's like adding more players to a high-stakes poker game where the total pot hasn't changed yet. Your individual odds of taking home a big cut just went down, and you're just sitting there hoping these new players eventually bring enough cash to the table to make the game worthwhile.
That's a great analogy. And while you wait for the total value of the company to grow, your fractional ownership stake is mathematically reduced. The company is wagering that the massive AI contracts and the modernized grid will generate enough future revenue to outpace the drag of that dilution.
Which is a big bet.
It is, because the dilution is a guaranteed immediate cost to current shareholders, whereas the AI revenue is a future projection fraught with construction and execution risk.
And speaking of risk, there is another major vulnerability hidden in their financial projections regarding the transition to renewable energy, specifically tied to the Federal Inflation Reduction Act.
Yes.
Now, to be clear for everyone listening, we are just looking at the financial mechanics of the Inflation Reduction Act as laid out in the sources.
Yeah.
We are not taking any political stance on the legislation itself. But mechanically, how does this federal policy directly tie to their local bottom line?
Well, a significant portion of DTE Energy, DTE's future profitability, relies on renewable natural gas, or RNG, tax credits, and specific subsidy provisions within that federal legislation.
Okay.
RNG involves capturing methane emissions from massive landfills or agricultural dairy farms, processing it, and injecting it into the commercial gas pipeline. It is an incredibly capital-intensive process to build those capture facilities.
Very expensive, but the tax credits flip the math, right?
Exactly. The federal subsidies transform a capital-heavy environmental project into a highly lucrative revenue stream. The company has modeled its entire transition to solar, wind, and RNG infrastructure around the baseline assumption that these federal tax credits will remain intact.
But what if they don't?
Well, DTE Energy, DTE, has managed to safe harbor their renewable investments through the year 2027, meaning those specific financial credits are legally locked in for the near term regardless of administration changes.
Okay, but looking post-2027, any significant legislative shifts in federal tax structures could completely alter the financial viability of their long-term renewable projects.
Yes.
It introduces a massive macroeconomic variable into what is fundamentally a localized, Michigan-based utility business.
It really is a critical layer of policy risks stacked on top of their local regulatory and infrastructure challenges.
So, to summarize where we are at, we have a company aggressively positioning itself to power the AI revolution. They are securing massive, unprecedented contracts. They are modernizing a historically fragile grid with smart technology, and they are continuing to pay a very solid dividend to their investors.
Correct.
But on the flip side, they are funding this aggressive expansion by diluting their own stock, relying heavily on federal tax credits that may face future headwinds, and operating in a climate of almost unprecedented public hostility over rate hikes and outages.
It's a very precarious balance.
Which leads me to one final provocative thought. If the disconnect between the stock price on Wall Street and the street-level experience on Main Street becomes too wide, could we see a real, tangible legislative push in Michigan to force utilities like DTE Energy, DTE, into municipal, publicly owned models?
That is the big question.
Because we are already seeing whispers of it in local community forums. If grassroots movements actually start targeting the company's legal monopoly status, demanding that power generation be treated strictly as a public good rather than a for-profit corporate enterprise, that could permanently shatter the entire investment thesis.
Absolutely.
It wouldn't just be about fighting over rate hikes anymore. It would be an existential threat to the corporate structure itself.
History shows that when public utility performance fundamentally fails public expectation for extended periods, the political landscape tends to shift drastically to close that gap. The threat of municipalization is the ultimate tail risk for any regulated monopoly operating with low customer satisfaction.
The numbers on the screen have to eventually answer to the reality on the ground. Our listeners, what's your take on the future of DTE Energy, DTE? Are you bullish on the AI data center boom, bearish on the customer backlash and regulatory risks, or are you just sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.